Hey everybody, it's your boy, Sean McLaughlin, at Options Sean on the old Twitter X. Hope you guys are doing well. It's a bull market, you know. Hey, so this is What Are My Options? This is a new show we're doing here, an opportunity for you to ask questions. If you want to learn how to trade a certain option strategy, or if you have a chart or a ticker in mind that you're thinking about trading options on, but you don't know what to do, or you're looking for some ideas, throw them in the chat. Let's talk about it. I have something we'll talk about here in a minute. First off, let me apologize. I might have some food in my teeth. I just realized I was eating a sandwich and probably should have made sure I was my face was clean before I went on camera. Anyway, hey, by the way, completely unrelated to the stock market. I just learned of this like literally 2 minutes ago. Rest in peace, Ozzy Osbourne. Holy cow. What a time to go out. What a way to go out. For those of you who don't know, Ozzy Osbourne, lead singer of Black Sabbath, amongst many other things he's famous for. Dude, just literally like 2 weeks ago, had the greatest concert of all time, like the going away party for Black Sabbath. They were saying this was the last show and that was it. Like all that, and all the rock stars came out to celebrate. They were all there. It was like a reunion of anyone in music. Everybody was there. And wow, 2 weeks later, guy passes away. R.I.P. Ozzy Osbourne. Holy cow. Holy cow. I mean, I'm still processing. I just learned this just literally right before we went on camera. Holy cow. Anyway, all right, we're not here to talk about that. All right, I see some questions coming in. Good, good, good. I see some Charles is asking about Target and Rocket. So let's just jump into that real quick. I gotta bring my keyboard over here. Okay, Target. Let's bring up the Target. Gene, if you want to put my screen up there. All right, so Target. Ooh, I like the way this is trading right here. Kind of coming off this flat base here. I don't know what kind of pattern you call that. I'm an amateur chartist at best. I work with some of the smartest technical analysis guys and girls in the business, as you guys know, at All Star Charts. But I consider myself an amateur chartist. I use charts. I'm not a chartist. But I look at this pattern. I'm like, wow, I would buy that. Volatility's low. If I were to go to the options chain on this target here, and maybe go a little further out, maybe go to December, give myself some time. I mean, actually, let me back up here. One of the things I look at every time when I'm about to put an option trade on, let me clear this up so it's a little easier for you guys to see. This chart here at the bottom of my screen, these blue lines, this is the implied volatility of the options. Okay, this measures the expensiveness of options. When we're at the lower end of this range, options are cheap. When we're at the higher end of this range, options are expensive. Okay, and no surprise that options were the most expensive here in April when Target was making lows and the whole tariff tantrum stuff was going on. There's a lot of fear in the market. When there's fear in the market, options prices get bid up. But we're off of those highs now. Or we're actually we're not at the lowest of the lowest level of the range, but we're kind of down there. I think we have a bid in the volatility a little bit because we probably have earnings coming up. Let me check on another screen here. I think I'll get that earnings date for you. Target. The earnings date for Target is, oh, I don't have it. It's not showing up. Okay, never mind. But I think a stock like this with volatility where it is, I think you could just keep it simple. And I think you could just buy calls. Let's look in I like December. There's no magic in selecting an expiration, but I like to give my trades time. I liked 3 to 6 months generally to give me some time. And then if I'm simply buying a straight call, I will often try to find an option with approximately 25 delta. If you notice here, this column here where my mouse is, this is the delta values of each of these strikes. And we have a 29 or a 23. So let's just choose 29. That corresponds with the December 125 calls. You could buy them for about $4 right now. They're bid 395, offered 410. Maybe you put a limited order in for 4 or 405. I'll bet you'll get filled. And then if this thing wants to climb up the side of that base and maybe even get back to the levels before this earnings surprise gap down at the end of the year. If this thing gets back up to 150 and you bought the 125 calls that you paid $4 for, I mean, you're looking at those things are going to be worth at least 20 bucks, 25 bucks that you paid $4 for it. That's 5x your money. I like that. I would keep it simple there. I forget who asked that. Charles, I think. I would keep it simple, just buy calls. And you know what? In this market environment, with volatility as cheap as it is across the board, I mean, let's look at VIX real quick. If you look at VIX, I mean, look at where VIX is. I mean, we are at the lowest levels we've been for, basically the whole year. Okay. I mean, we were slightly lower in late January and mid-February, but basically this is this is fear of falling to sleep is what this is. So when you see that, generally speaking, you're going to see lots of opportunities for just being long options premium. So whether you're buying calls or puts to express your bullish or bearish bent, maybe some call spreads for some more expensive stocks, but being long premium generally is the move. I mean, everything has to be evaluated on a case by case basis, but yeah. So here's Rocket. This is the other one that Charles is asking about. I mean, this Rocket is rocketing over the last 2 days, but you're seeing volatility spike as well. This one also might have earnings coming up pretty soon. I'm not saying that's the reason, but this is one of those names that I'm not calling it a meme stock. It's not a meme stock, but this is one of those names that when it starts moving like it's moving right now, that could juice the options because the speculators are just getting involved, right? So if I look in, let's say December options, let's just do a quick little quick and dirty measurement. We'll go $4 away on the call side. Those are bid at $1.50. $4 away on the call side. Look at that, or on the put side, they're bid 75 cents. So you're paying twice as much for a call that's equal distance away as the put. So yeah, you're seeing the speculative juices coming in. People are paying up for this thing. So in this situation, if I were to buy Rocket here, I mean, boy, I feel like I might be a little bit chasing here. Although if it clears 116, which is where we're at right now, this thing could take off. But I think if I was forced to put a trade on right now, I think I would do this with a bull call spread because there's a lot of premium in those out of the money options. So, maybe look at buying the 16 strike, which is at the money here in December, and go to I don't know, just go 21 to make it an even $5 away. Sell the Oh, there's a lot of weird strikes in here. Sell the 21. So it cost you $1.54 to put on a $5 wide spread. Not the best price. I generally like to. Actually, that's not bad. That's not bad. Okay, $1.50. Looks like we can get about for $1.50 right now. We can buy that. Buying the 16, selling the 21. The most that spread will be worth is $5. All right, you buy it for $1.50. If I were to buy that right now, I mean, let's pull up the analyze tab just so you can see what that looks like. Oh no, we got to do this. We have to analyze this trade. I already have a position on there, so let's move that out. So if you were to put this bull call spread on right now, you see that this is how the P&L graph of a bull call spread looks. You got defined risk. You can't lose more than you pay for it. So if you paid $1.47, let's just call it $1.50. If you paid $1.50 for it, that's the most you could lose at expiration day. But the defined risk of a bull call spread also comes with a trade-off, and that is you have limited upside. The most this spread could be worth is $5. So if you paid $1.50 for it, your max profit would be $3.50. And if you just did a one lot, that's $350 profit. Nothing to sneeze at, of course. That's a great profit, but your gains are capped. So if I were to put that trade on, I would take it off in one of two ways for a profit. I would either sell it. I'd leave a good till cancel order to sell it for $3, which would double my money. Okay, so I paid $1.50 for it. Sell it for $3, double my money. Great. And or if it gets up to 21, if the stock trades at 21 and I still haven't gotten hit at my profit target, at that point, I'll probably just sell the spread for whatever profit it is at that point. If we were to get there today, I'd be looking at $116 profit. Hey, not bad for one day of risk, right? Ideally, we'd want the this purple line, which is the P&L today, to be closer to the blue line, which is the P&L at expiration. And if I move forward in days, I got a little thing here on the bottom right of my screen. If I scroll forward in days, you can see how the purple line slowly starts morphing into the blue line as we get closer and closer to expiration. All right. Okay, let's get back to today. Go to today. All right, so that's Rocket. All right, weekly looks good. Risky business. How did you miss DHI? Yeah, it's one of those home builders, right? They're all ripping today. I'm in KB Homes, which is small consolation. But yeah, DHI is ripping. Toll Brothers is ripping. KBH is ripping. It's about time, man. My analysts have been pounding the table on these home builders, playing catch up. Are we finally there? I mean, man, we've been talking about this for weeks now, and it's been a slow grind. But yeah, DHI moving. Um, I don't know. It feels like a chase right here, right now. If you weren't already in it, it looks like they just announced earnings, so that's why they are moving. Or are the earnings later? Let's see. See if it tells me on my screen here. Can't seem to click it. Okay, never mind. Jay says target earnings, by the way, we were talking about Target earlier. Target earnings are August 20th. So we got some time on that. No big deal. Although I'm seeing someone else say August 13th. There seems to be conflict. Bob, Bob and Jay are on the 820 train and Charles is on the 813 train. All right, whatever. Earnings are coming up. Something to know. All right, I see a question here. Sean, do most charting platforms have implied volatility indicator to add to the chart? Well, Paul, I can't speak to most charting platforms. I have not used all trading platforms, but I can tell you the ones that I have used that do have it. My platform you're looking at here, this is ThinkerSwim. Obviously, ThinkerSwim offers it. The other platform I use is Tasty Trade. They have a version of it. They call it implied volatility rank. It's their own proprietary thing, but it's similar. I mean, they're gonna trade. They're gonna trend the same. So they call it IV rank or IVR. Um, those are the two that I use. You know what? Interactive Brokers. I used to have, I had an Interactive Brokers account earlier this year. I was playing around with, it, and they also offer it too. So, Interactive Brokers, ThinkerSwim, Tasty Trade, those three certainly offer implied volatility. You know, the online charting platforms like TrendSpider and TradingView, they don't offer implied volatility, which has always been very frustrating. At least I don't think TradingView does. I haven't used TradingView in a long time, but last time I used it, they did not have it, and I know that TrendSpider does not. Um, but if you're a serious options trader, you're probably using either ThinkerSwim, Tasty Trade, or Interactive Brokers, and they've got what you need. So there you go. So, sorry if I didn't answer that question for you the way you wanted, Paul, but that's what I know. I can't speak for any other platforms. Uh, Okay. Yeah, so I've seen some guys in my chat room talking about this donut, Krispy Kreme. I guess this is the meme stock du jour. Did they announce that they're going to be holding Bitcoin in their treasury or something? They're going to turn donuts into Bitcoins. Is that the deal or something else? I don't know what's going on here. The implied volatility is through the roof. I mean, if you bring up these options right now, I mean, the August options that expire in 24 days, they're pricing in a annualized 289% volatility. Basically, they're pricing in a move of 289% to the upside. That's what they're pricing in. At least the at the money options are in annualized terms, of course. So a lot going on. I think I saw Bob. I think I saw you talk about doing a calendar spread. It's tightened up a little bit since you brought it up, but if you look at the donut here, notice if on the right-hand side of the screen, it shows the implied volatility of the at-the-money options for each monthly expiration. So you can see 289 in April versus 203 in September. So Bob in my chat room earlier today, I saw him talking about this. It's a great idea. Bob's got great. Shout out, Bob. You have great creativity, man. I love it. I love it. So anyway, he was talking about doing a calendar spread. So what you would do is short the at the money call. Okay. Well, it could be any strike, but we're doing the at the monies. You buy a calendar spread where you short the August calls and you buy the September calls, same strike. And oh, I did a sell. I didn't mean to do that. Hold on a second. There we go. So you buy it for you sell the August 5 calls, you buy the September calls, you pay 23 cents for it. And what you're betting on in this situation, let's bring up the analyze tab here. What you're betting on in the situation is one of two things happening for you. The stock is trading right there around $4. Okay. So actually, you're betting on three things happening for you. Number one, you're betting on the stock going up to about $5. If it gets to $5 and it pins there, all right, then what's going to happen is, or let's say it closes at 4.99, just to be complete. All right. If it closes at 4.99 on August 15th, which is the expiration day of the short options, what's going to happen is those August calls that you are short, they just go away, they disappear, they expire worthless, and you're still left holding the September 5 calls. And you will make money in that trade because of those August calls will have decayed away to zero, and they've decayed a lot faster than the September 5 calls will. Okay, so that's just a typical calendar spread. Now you've got added juice in this situation because you can see here in my chart again, or on the bottom, you can see these percentages. You're shorting the implied volatility that's at 257, and you're buying the implied volatility that's at 198. Those things should converge at some point, right? Either this 257 comes down or that 198 goes up. Either way, they're going to merge closer together as we get closer and closer to expiration. And that's gonna add value to your spread, right? Because these short options that have so much implied volatility, that's going to have to come out. All right. So that's going to come out in your favor. Meanwhile, you're still long those September calls, which give you another month to play. So you make money in a trade like this. The simple way is if the stock trades up to $5 and hangs out there between now and August expiration. Or the stock does absolutely nothing. It stays right where it is. Or right now we're trading just shy of 4. That's okay too, because again, those calls are going to expire. Those August calls are going to expire worthless, and you're still going to have the September calls, and you're capturing all that spread. You're capturing that spread of this 256 implied volatility collapsing on you. So you make money by the convergence of the volatility. You make money by the stock staying put. You make money directionally if it gets up to around 5. You don't want to go past, like, say, $6. But as you can see, with a call calendar spread, this area here, right around the strike, around $5. That's where your max profit potential is. But once you get above 5, if this thing rips, if it's one of those meme stocks, this thing could go to 10, right? Once you get above 5, then you get on the backside of the structure, as long as you still have those short calls, right? So if the stock moves past $5 before August expiration, then all of a sudden your potential gains are now shrinking, right? Because you have to cover those short calls. And if a donut goes to 20, right? Those calls are basically going to be at parity. Because they'll be so far in the money, there'll be no premium left in either of them. They'll both basically be trading for their intrinsic value. So it'll cost you it'll cost you the same amount of money to close the August options as you'll get to sell the September options. So you'll get basically zero for it. So the most you can lose on a credit spread, or I'm sorry, on a calendar spread, is what you pay for it. Right now it's trading for about 18 cents, 18 to 20 cents, let's say. That's the most you can lose. So it's a defined risk trade. But I do like it. Bob, great idea, my friend. Let's see, what else I got here in the chat here. Someone's talking about ACHR. I had a little flyer position on that thing recently that I got out of. I didn't like the way it's traded the last 2 days. Oh, hold on. Got an alarm going off here in my office. I don't know what that's for. Donuts. Yeah, so ACHR is bandied about heavily in various ASC missives with videos. Take a hit today. How might you play it? Well, Phil, I was in it, and I got out. Yeah, I got out. I had a little simple call trade, and I think it was along the August 13 calls, and when it rolled over yesterday, I was like, nope, I'm out. And you know what? That brings up something I wanted to talk about, guys. JC talks a lot about how the S&P 500 is the greatest trend following strategy ever invented, right? And why is that? Do you guys know what he means when he says that? He says that because the S&P 500 basically kicks out the worst stocks whenever they make adjustments. They make it quarterly. I forget how often they make the adjustments to the S&P 500, but the SPY ETF, or it doesn't matter, just the SPY, the S&P 500, they kick out their worst performing names and they add in new names. And what they're doing that's a trend following strategy, right? That's why the S&P 500 over the long course of history is always going up. Why? Because it always kicks out its worst performers and it always adds companies that are growing. It's the American way, right? And so the index is built to go up over time. Now, it doesn't always go up over time. We have bear markets, we have corrections, we have crashes, right? We have all of these things. But on a long enough time frame, stocks go up. And when the worst stocks are getting kicked out and the best stocks are being added, that means that over time that index is going to go up. Now I bring that up because I want to show you guys something here. This is my monitor tab. These are all my open positions. Now these are not all-star options positions necessarily. This is a different account that I have. This is a very speculative account that I trade. I trade very small. My positions start out at like a $300 risk, nothing major. Okay. This is a very speculative account. I don't recommend this for everybody, but I want to point out something to you because it gels with this whole S&P 500 as the best trend following strategy in the world. Look at here at this column here, P&L open. Okay, this is the open P&L I have in my positions. And I have them sorted by the highest open P&L to the lowest. And if I scroll down here, I got a bunch of positions on. I think I got like 55 or some crazy positions, maybe even more. A bunch of zeros here because I closed these all today. But you'll notice here at the bottom, these are my positions that are currently losing. We're not losing a lot. My biggest loser, open loser right now is $51. No big deal. Okay. But what I do with this, guys, is again, this is a very active portfolio. I'm doing lots of trades every day. It's a very speculative thing, something I do for fun, for whatever. But what I'm constantly doing, guys, is I'm constantly monitoring. I don't give a shit at all about all these trades that are winning. I mean, I do, right? I'm happy to have all these winners. This is great, right? But I'm not paying attention to these guys other than maybe, oh, that's interesting. Like I'll maybe pull up a chart of QS and see how it's doing today because it's my biggest open winner right now. But where my focus is being paid throughout the day is at these losers down here at the bottom. All right. I want to cut losers as quickly as possible. I don't want to take large losses. Now, every one of these trades is defined risk. I already know the max I could lose in each position, and it's less than 1% of my account, so it's okay. I don't want to lose 1%, but if I did, I could come back from that. Okay. But I want to cut these things a hell of a lot faster. And so I'm watching these things. And for me, this is just an arbitrary number. I'm risking all these positions are sized between $300 and $400 per position, right? At the start. I don't want to lose more than $100. $100 is when I start getting nervous. If one of these things is down more than $100, I automatically close it. I don't care what the market's doing. I don't care what the chart looks like. If I'm down more than $100 in a trade, it automatically gets pruned. It's gone. Okay. Now I also close losers when, I only want to have so much of my capital committed to the market, right? I don't want to have all of my dollars at risk. Again, this is a very specific account meant for speculative trades. And so, I'm very aggressive with this account, and I don't recommend this for everybody, but I have a number. I have a maximum amount of risk I'm willing to have portfolio wide, right? So for example, if the New York Stock Exchange closed down suddenly for a week like it did during 9/11 and all trading stops, or maybe it closes for a lot longer. In fact, during World War II, or was it World War I, the New York Stock Exchange closed for several months. I don't know if people know that. A little fun fact for you. If that were to happen, all these short-term options, these would expire worthless if they're out of the money, right? So I could potentially lose all the premium I have. So I have a maximum amount of risk I'm willing to have on. And so when I'm at my maximum amount of risk and a new trade pops up, a new idea that I want to trade, and I'm like, oh, this is a great setup. I want to get in, but I'm at my max risk. I can't add any more risk. Well, what do? I look at my position tabs. I look at my position that's down the most. In this case right now, it's TTEK. And I say, all right, sorry, T-Tech, you're not working for me. I got a better idea. I go in and I close that trade. And then I redeploy that capital into my new idea. Okay. So all I'm constantly doing all day is kicking out these small little losers and holding on for the big winners. All right. I'm letting these guys out here up at the top of my screen. I'm letting these guys run as long as they can run. And I'm not even paying attention to them. So in a way, that's like the S&P 500, right? The S&P 500 is constantly recycling its inventory, right? It's constantly kicking out the losers, adding new winners, repeat, ad infinitum. Did I say that right? And so if it works for the S&P, why can't it work for me in my portfolio? All right. So I just wanted to bring that up. I think that's a good teaching lesson for everybody. Because I wrote last week. If you guys read my newsletter, if you don't, I'll put the link in here. You guys should sign up. It's free. I write most days of the week. But I wrote last week that in a bull market like we've been having right now, we can't possibly trade everything. I mean, you saw my position tab. It looks like I'm trading everything, but there's positions I've missed because I have too much risk on, or I was away from my computer when the breakout happened and I missed my entry, right? You can't possibly trade them all. It's impossible, but you have to have a system for, bringing in new ideas, kicking out your worst ones, and just putting your money where it's being rewarded. All right. Let's see. Robert asks, what is your favorite scan for options? Do you have a custom in TOS? I do not. I do not scan for options. I get my ideas from a variety of places. Obviously, I get a ton of my ideas from All Star Charts, from the research team here at All Star Charts. They publish fantastic research, a lot of ideas, and I cherry pick what I think are the best ideas. So that's where I get the majority of my ideas. I also I'm active on social media. There's a bunch of people I follow, smart people I follow. I've pruned my list in a lot of ways, and if the people that I'm following are bringing up a certain stock that they think is worthy of attention, I'll pay attention. I'll put it on my list. I'll set an alert. I'm always setting alerts. I mean, you can see right now in this Archer, I closed it. I closed it yesterday, I think. Yesterday or today, doesn't matter, but I'm out. But look, I put this right here. It means that that's an alert. If it gets back up to 1252, I might get back in it again. But that doesn't necessarily mean I'm going to trade it, but at least I'll get alerted that the stock is back above 1252. I might put a trade on that way. So I'm getting ideas from all kinds of places, primarily All Star Charts, but also from other smart people that I follow, other smart analysts, other smart people on social media. Um, I've got friends in trading, right? We talk all the time. And so wherever I get ideas, if something looks good, I'll put a little alert on my chart to let me know where it is that I would like to take action. Some analysts might like to buy it right here, buy the dip, and I have no problem with that. But for me, I'd rather see it come back up and clear this level, this level, this level here. I feel like these are significant levels here around 1250. So that's where I'll get in. So that's where I get my ideas, Robert. I know that's not a perfect answer for you. I know that ThinkerSwim has a scanner. And in fact, I joke about this all the time, but I've been a ThinkerSwim customer since the very beginning, since pretty much the year or two after they started. So I think I opened my first account with them in like 2001 or 2002. And I can tell you guys, this is a very powerful platform. It does a lot of things. But in my 25 years with this platform, I've probably barely used 3% of the capability of what this platform can do, including those scans. I don't use the scans. So sorry, Robert, if that wasn't a satisfying answer, but that's how I do it. And also, I guess the other idea that other place I find ideas is I just use my own brain. I look at chart patterns. I see patterns that I like. I have my favorites. I mean, you guys have heard me talk about this a lot. My favorite breakout in the world to buy is a stock making fresh all-time highs. That's my favorite pattern in the world. I don't care what the chart looks like. If it's making fresh all-time highs, like for the first time in months, like not just like it's been going up every day for 50 days straight. I mean, like a first all-time high going back at least over the last 5, 6, 7 months. I love buying those. Blue skies ahead, man. There's no upside resistance. There are no bag holders. There's nobody looking to sell to get back to even. Blue skies, baby. So if I see those chart patterns as I'm out in the wild and looking at different stocks that I'm aware of, I'll trade that as well. Okay. Yeah, you missed DHI as well. Everybody, look, I mean, the home builders are going. I bought Toll Brothers here in my little personal account today, in this other account, and I've been in KBH. I'm loving it. I'm loving it. All right, guy. Oh, I told you guys I put in link to my uh, newsletter. So let me find that for you real quick. I should have this more easily accessible. Here it is. Bum 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 bum. Where'd it go? So free options newsletter. Here you go. I'm gonna put it in the chat. Bada bing, bada boom. There you go. If you guys are not subscribed to that, please do. I'm biased, but I think I'm writing some good stuff on a near weekly basis or near daily basis. I talk about things about options trading. I talk about trading philosophy. I talk about all the places that I fuck up because I think you could all relate. Um, I talk about things that we traders, have in common. So I think you'll find it interesting. All right, guys. Well, we've been kicking around for 32 minutes. That feels like a complete show to me. I'm happy to stick around for a little bit longer if anybody has any specific questions. Um, Otherwise, market's moving, man, and we got trades to make. We got trades to make. Phil, thanks for the shout out, dude. I love it. I love it. Thank you. Thank you. Um, all right. I think that's it, guys. Thanks for tuning in. We're gonna be doing this every week. We're still monkeying around with the flow of it, like when we're gonna do it. We're gonna change the time. I don't like doing it right now, the hour before the market closes, because this is a busy time for trading and other things. So next week we're gonna kick off a new starting time. It's still gonna be on Tuesdays, but we're gonna start doing it at noon Eastern time starting next week. I hope that's okay with you guys. A little bit more middle of the day when things are a little bit slower. Maybe people are eating lunch. Maybe it's a little easier for you to watch and tune in. But yeah, doing it right now in the last hour of the day when there's trades to happen, there's trades to manage. It can be a little tricky. So thanks for tuning in, guys. This has been What Are My Options? We'll see you again next week. I'll be on tomorrow with an options masterclass at All Star Options, All Star Charts. Check it out. And Thursday, I'll be back with the options jam session where we review open positions we have in the All Star Options portfolio. All right, everybody, take care. See you tomorrow. Bye bye.